Welcome to the M2I Alternative Investments Chat, where we demystify the world of alternative investments and financing for entrepreneurs and investors alike. With these discussions, we hope you're more empowered to unlock new opportunities in your business or portfolio.
So welcome back. In our last episode, we talked about equity offerings, and today we're actually going to talk about the alternative way, which is a debt offering. So if I told you, Erin, there was a way to secure funding without giving away your company, what would you say?
What is it? Tell me more.
Tell me more. Well, let's dive into debt offerings and help you stay out of the Shark Tank and still get your capital you need for your business.
Yeah. Okay, so let's talk about a debt offering. What is a debt offering? A debt offering is when a company offers to borrow money from investors under the agreement that it'll pay back that borrowed money with interest. The company essentially is selling a debt security to an investor. The investor won't earn stock units or dividends from the sale. However, they do earn interest payments.
All right, so you still get some money out of the company.
Of course, yeah, it's an investment after all. That's the goal, right?
Yeah, so it sounds like the main difference between debt and equity financing is that equity provides extra work capital with no repayment obligation. That's kind of cool. Give me your money. I'm out.
Yeah.
This new cool stuff. But as far as a debt offering, it's a loan. So you're going to take on this money. You still get to spend it.
Yes.
But you got to give it back to the person that gave it to you, and you got to give them some interest.
Yeah. And typically these have some high interest tacked on, which can be really attractive for that investor, but also can be a little daunting for the person or the company that is, giving this debt offer.
I see. So what are the types of debt offerings out there?
Yeah. So a bond, which is something that we all know about.
A James Bond?
No, not a James Bond, not 007. But if you think about a bond, I remember hearing about bonds in elementary school, and I don't know why, but I feel like my teachers were always telling me I needed to buy a bond. I'm like, ma'am, I'm 7. But
Reminds me of Blast from the Past.
Yeah.
Brendan Fraser.
I don't have money to buy a bond. I'm 7. But it is similar to a loan, only it occurs between a company and an investor. So when selling a bond, an investor agrees to pay the company a specified amount of money for a given period of time. And then when that bond has matured, that will come back to them.
Okay.
So bonds are debt securities. Again, the company promises to repay the beholder, the person who purchases the bond, money back. And there's usually periodic interest payments called coupon payments throughout the life of the bond. So that's how they're kind of getting that income from it.
Oh, okay. I totally understand. So what's the other way? I hear this thing promissory note. I don't like a promise ring, like a promise.
Or a P-note.
A P-note.
P-note, yeah.
Tell me about these.
P-note is a sassy way to say promissory note. When a company issues a P-note or a promissory note, it means that they are making a written promise to pay a specified sum of money to another party at a specified future date. So it's almost like an IOU.
Oh, okay. So you just kind of gather these little IOUs.
Yeah.
So it sounds like it's a debt instrument similar to a bond, but typically simpler and more informal.
Yeah, it is a little bit more informal. If you think about a P-note as an IOU, the way that I almost think about it is usually when I picture an IOU, it's somebody who took some money out of your piggy bank and they write this scratchy note, and then they put it.
You $20.
I owe you $20.
And then you break your piggy bank and you find it.
Exactly. Obviously, it's not that informal, but if I'm trying to kind of keep these things straight in my head, that's how I think about the informality. Okay. They typically have higher interest rates than bonds, making them attractive for investors. So
that makes sense. Get a little bit more money.
Exactly. And bonds are usually seen as being a pretty stable form of investment. And a P-note, again, a little bit more risky. So in order to entice investors, those interest rates are a little bit higher. Bonds are considered long-term securities. You'll see some bonds that are 30 years out. Promissory notes are shorter term, so that you can get that money, investors can get that money back a little bit faster.
That makes sense. So what happens if the two want to meet?
The two want to meet and have a little
rendezvous.
Have a little baby. Well, if we think about a convertible bond is a fixed income corporate debt security, yields interest payment, but can be converted into a predetermined number of stock or equity shares.
Oh, so you kind of get from last episode a little bit of share stake, but then you also get your moolah.
Yep.
And you get the top down convertible style.
Yeah, exactly.
Looking good.
Yeah, exactly. So that can be attractive. The conversion from bond to stock can be done at certain times. Those are specified.
Okay.
And that's at the discretion of the beholder or the bond holder. And the convertible bond offers investors a type of hybrid security. So again, like we're saying, had a little baby, it's a little hybrid. And this can feature interest payments and also providing the opportunity of owning stocks. So you get a little bit of, the two. So as
Best
an
of both
investor, yeah, you get to kind of think about what you want to do for your investments.
Okay. So what's the process of a debt offering? The company's got its product, they're going to take it out. What do they need to do to start getting this capital in so they can have more money?
Yeah. So a lot of these processes, as we're talking about them, are very similar. You're going to see a lot of overlap. Determine your financial needs. What do you need as a company that is requiring this capital? How much capital do you need? Think about that. Select the type of debt that you want the debt offering that you want to offer. Do your due diligence.
That research.
Diligence. Register your securities. Some of these debt offerings require that. So that's at the discretion of the SEC. So that's all outlined and listed, but that's something that you might need to do.
Yeah, because there are definitely some forms I've seen on the SEC for different offerings, even though you're not giving off equity, but there's certain forms you have to fill out. So you want to make sure that you understand which offering you're selecting. So make sure all the forms are filled out. The government likes forms. So
yes,
get
lots
those done.
Lots of forms. And then also you'll want to set your terms and pricing. Again, how quickly are you going to be paying this money back? What is the interest rates on these payments? When are you making these payments? Those sorts of things.
Got it. Need to outline everything, just like an equity offering. Give your investor all the information up front, transparent. Hey, you're going to give me this amount of money. I'm going to give you this amount of money with this much interest. I'm going to pay you every month, this amount, yada, yada, yada.
Yeah.
All the things.
Exactly. And then you'll want to market that offering. You're going to want to try to find investors. So start marketing it, and then you'll start accepting those investors. And that's kind of the end of the life cycle of that beginning stage. Okay, so why would you want to do this? Why would you want to have a debt offering, Erica? What are the benefits?
So we talked about this last episode. You don't give up any equity, but debt financing allows a business to leverage a small amount of capital to grow. Mm-hmm. So it's less costly. There's always forms and stuff to develop, but when you're doing debt, it's, like you said, P-note, bond, very simple. You don't have to worry about, okay, this person has 20% and this person has 40% and then this and this and this and this. It's you give me money, I spend your money, I give you money back, a little bit of extra. So there's interest deductibility, which means that the interest payments that you're paying your investors, they are typically tax deductible, which is great for a company because it can result in significant tax savings for the company. This tax advantage makes debt financing more cost effective compared to equity financing, where dividends are not tax deductible. Again, we touched on this earlier, but you get to maintain control and full ownership of the company. These people are just loaning you money, so you do have to repay it. But if you decide, like we said in the example last episode, if you decide that you want your scrubby to stay purple, it stays purple. Yeah. Nobody can say otherwise. Everything is up to your discretion. There's also fixed cost of capital. So debt financing provides companies with a fixed cost of capital in a form of interest payments. They know exactly how much money needs to come out every single month. It's fixed. Yep. So I have this amount of investors. I owe them 5% interest. Here's how much. You can easily do the math, and you know exactly what your bills are going to be. Yeah. Like game planning for your business. Exactly. And it gives predictability. And so you can definitely know, how long you have to pay off that debt.
Ding, 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 capital planning.
Ding, ding, capital planning. Our favorite thing. And then lastly, you've got flexibility and control. So companies can tailor the debt agreements. So again, as you are speaking with investors and you're saying, hey, I need this amount of money, you can be a little bit flexible. You're like, okay, I'm going to take this much from you. I'm going to give you this much interest. It doesn't have to be the same for every single person. It doesn't have to be the same for every single offering. Everything is tailored to what your business needs. So you don't have to, you don't have to relinquish ownership or control to get these investors. It's on your terms.
Yeah. Well, that sounds pretty good. Let's talk a little bit about the risks and considerations.
Tell me about the risk.
The biggest thing that we touched on are those interest payments. Again, no matter how your company is doing, you are required to pay that money back. So if you are experiencing financial difficulties or cash flow constraints, that might be a struggle or difficult. So it's something to consider, and this can lead to default or financial distress. And also credit risk. We talked a little bit about the credit risk before, but debt offerings expose companies to a credit risk, which is the risk of default or non-payment by the borrower. So that's something to also acknowledge. Basically, if your company is doing well and making money and you're able to pay your payments, you're good. You're golden.
Everyone's happy.
Everyone's happy. But of course, when you run into financial problems, that is a trouble no matter what situation you're in.
Yeah, because you have an obligation to pay those people back. Unlike equity, where you're just like, well, sorry, you're out of luck.
Yep.
These people are expecting their money because they gave it to you. They don't own any part of your company. They are expecting those payments back.
Yeah, that's the agreement. And then for investors, there's liquidity risk. So debt securities lack liquidity. Again, if we're talking about stock market, you don't want it. You want to get rid of it. Debt securities don't work exactly like that. So that's difficult. And also, they can be challenging to sell during periods of market stress or volatility, which of course is true just in general, but that's just something to think about or consider. And also potential loss. If that company can't pay you back, again, they're required to, but if there's some struggles down the way, that might affect you as well.
Yeah.
And then if we're going to talk a little bit about case studies, what is a company that has done a debt offering that we might know about?
Well, there's one little itty bitty company. I don't know. A lot of people haven't heard of them, but it's this fruit called Apple.
Oh, Apple.
Apple actually famously raised capital via debt offerings multiple times. Yeah. So they raised about 8.5 billion with a B in May of 2020. They did another debt raise and they took on about 5.5 billion in August, and then another 14 billion. These people be raking in the money. February of 2021, and then they raised a measly 6.5 billion in July of 2021. Yeah. It's crazy. Again, think about Apple. Think about all the things. How would you feel if you were an investor in that one? Sorry, Steve Wozniak. Anyway, but these are very, very successful. So the nice thing about these is maturity ranges from 2 to 30 years. So as a company, you sometimes can have a longer period of time to pay back these investors. What are some other successful things?
Well, if we're talking a little bit more about Apple, what they've said is that they're utilizing these debt offerings to fund stock buybacks and dividends, which a lot of folks in the financial tech space are like, this is interesting. Why do you need all these billions and billions of dollars to do that for this kind of routine or kind of boring thing? So there is some talk and some speak about maybe Apple has a new line of products coming out. Maybe there will be an Apple car. Maybe there
Do you
will
think
be
it'll be shaped like an apple? If it is, I'm so on board. I would drive around a little apple.
Yeah. So there's, obviously a reason why they're doing these huge capital raises. And I guess just time will tell as we see Apple kind of continue to unfold. I mean, we all pretty much carry around an Apple device in one form or another.
I know, my computer's due for an update tonight.
Yeah. Yeah, exactly. Or coming to you live from an iPad. So yeah, just something to keep an eye out. And again, I think that, Apple's not done doing their debt offerings. So be on the lookout for more news on that.
Who knows? If you're an accredited investor, you might be able to have a little piece of the apple pie.
Yeah. Yeah.
Well, with this, we want to kind of just wrap up debt and our previous episode on equity as well. So most companies will need some form of debt financing at some point in their career. The additional funds allow companies to invest in the resources they need in order to grow. Again, it's a loan. Everything that you need to operate a business, from papers to pencils, all costs money. You got to spend it. You got to buy it somewhere. You can't write notes on in air. I mean, if you can, awesome. But I don't know how you're going to sell that to investors.
Coming to you soon from Apple.
Yeah, Apple Air. I love it. But small and new businesses especially need access to capital to buy equipment, machinery, supplies, inventory, and real estate quickly. And they don't want to give up the piece of that pie.
Mm-hmm. All right. Well, that's all for today on debt and equity offerings. We hope that you have a clear understanding on the two. Now that we've spoken about it over these past 2 episodes, we'll have more to dive into. So catch us on our next episode. We'll see you then.
Thanks for joining us. Stay tuned for more insights in our next episode. And don't forget to subscribe to continue the journey with M2I. See you next time.
The content provided in this podcast is for informational purposes only and should not be construed as professional, financial, or investment advice. This podcast should not be construed as an offer to sell or a solicitation of any offer to buy any securities. We strongly recommend that you seek advice from a qualified professional before making any financial decisions.